What's up guys, welcome back to InvestingPH. For today, we will look at one of the largest property developers in our country, which is Ayala Land. Now this pandemic really hit companies in our country hard, and one of the most affected by it is real estate companies. So let's see if ALI is a good investment and of course, if it's still undervalued or not. With that, let's start. So before we dive into this video, be sure to hit the like button first, and if you're still not subscribed yet, be sure to hit the subscribe button as well. Now who is Ayala Land? Ayala Land was formerly the real estate division of Ayala Corporation and was incorporated on June 30, 1988 to focus on the development of its existing real estate assets. In July 1991, the company had its IPO of its primary and secondary shares on the Makati and Manila stock exchanges. This is the predecessors of the now known PSE. Now 44% of the company is owned by Ayala Corporation, 54.56% by the public, and foreign ownership is at 21.33%. Now Ayala Land is one of the largest and most diversified real estate conglomerates in the Philippines. It is engaged in land acquisition, planning, and development of large-scale, integrated mixed-use and sustainable estates, industrial estates, development and sale of residential and office condominiums, house and lots, and commercial and industrial lots, development and lease of shopping centers and offices, co-working spaces, and standard factory buildings and warehouses, and the development, management, and operation of hotels and resorts and co-living spaces. The company is also engaged in construction, property management, retail electricity supply, and airline services. Ayala Land has 30 estates, is present in 57 growth centers nationwide, and has a total land bank of 12,483 hectares at the end of 2020. Now it's different than what is shown here since I think their website isn't updated yet. This came from their 2020 annual report. To summarize things up, we can break down Ayala Land's businesses into three parts: property development, commercial leasing, and other services like construction, electricity, etc. With this, the main bulk of their income comes from their residential business. Now if you look at their commercial leasing business and compare it to their pre-pandemic numbers, we'll see it was the one that was hit the most. Their profits was cut in half due to all the restrictions that the pandemic brought upon our country. Going back to 2021, if we look at their sales reservations for their 5 property brands, Ayala Land Premier, Alveo, Avida, Amaya, and Bellavita, 74% of sales come locally, 16% from overseas Filipinos, and 10% from other nationalities, of which 59% of them are Americans. As for the company's plan to grow more in the future, for the end of 2021, the company has allotted 64 billion pesos as capital expenditures. 52% of this is for their residential business, 17% for land acquisition, and 14% for estate development. Now they decreased their capital expenditures in 2020 and 2021. Well, this is a given since their revenues were cut down during the pandemic. Now Ayala Land also aims to be carbon neutral. Here we can see their progress from 2017 to 2020. Their net emissions drop every year. In 2020, they were able to reduce emissions by 91%. Well, if you've been to places under Ayala, it's easy to notice how clean the environment they provide to the people. With that, let's head on to their financials. I would still be following my checklist for our quick valuation for today. To understand more how I analyze stocks, do watch my other stock analysis videos after this. I also have a video for their competitors like MegaWorld, Philinvest, and Vistaland. First, their revenue. We can see since 2011, their revenue has been growing year after year, but as mentioned a while ago, the pandemic affected their business greatly, thus cutting their revenue almost in half, a negative 42.9% in 2020, putting their revenue back from its place in 2014. Though in their latest 12 months, they've recovered slightly by 8.67%, it's still far from its pre-pandemic numbers. But even with that, their 10 years compounded average is still at 9.56%. For their net income, the effect of the pandemic is greater, cutting their 2020 net income by 73%. This is almost equal to how they were in 2012. Like we've seen a while ago, their mall and hotel businesses' revenue was greatly affected. This was due to all the restrictions brought about by the pandemic. With this, their 10 years compounded growth rate is only at 4.37%. Now some of you may be wondering how these averages I'm showing work. For the 10-year average, this is from 2011 up to their latest 12-month, and for the 7 years average, this is a compounded growth from 2013 up to the latest 12-month, so I think you get the point for the remaining years. Moving to how well they produce net profits from their revenue, pre-pandemic they average around 15 to 20%. If you compare their net profit margin to Megaworld, Philinvest, and Vistaland, this is somewhat lower since those companies have a net profit margin of 25 to 30%. But in our overview of the company a while ago, Ayala Land doesn't only have real estate and malls in their portfolio. They also have logistics, electricity, and construction. With this, we can see they are consistent in growing their profits. The only exemption was this pandemic, which is understandable since most real estate companies had the same financials in the same period. For how well they are growing their equity, since 2012, they've had a positive growth year after year, even amidst the pandemic. Though it slowed down a bit, which is understandable, their 10 years compounded growth rate is 11.37%, which is a good growth for them. And as to how well they're using their equity to produce net profits, their 5-year ROE is 12.3%. Comparing it to their competitor, they have the highest ROE, which means they are more efficient in using their equity in producing net profits. But again, we shouldn't just look at ROE alone, for ROE can be influenced with a higher liability, because a high liability can increase the ROE percentage. With this, we move on to their debt to equity. They have a ratio of 2.21. In comparison with their competitor, Ali has the highest debt to equity ratio, so this may explain their slightly higher ROE. Now, is this alarming for us investors since their ratio is a bit high? Well, let's move on further to have a wider picture of the company. As to how well they're handling their short-term obligation or their short-term debt, their current ratio is at 1.46, meaning they have 1.46 pesos of current assets for every 1 peso of current liabilities. Though it's lower compared to its competitors, it's still well within the norm. They can easily pay up all their short-term obligations. For their free cash flow, the only time they have a negative FCF is in 2020, but they've already recovered quickly in their latest 12 months. Free cash flow is computed by cash from operations minus capital expenditures. This means even after all their expenditures, Ali still has leftover cash on hand. Now, since they have leftover cash, let's head over to their long-term debt. Now, this ratio lets us capture how easy it is for a firm to service its current long-term debt obligations. So the lower the number for this ratio, the better. A number less than 1 means, at a snap, the company can easily pay up all their long-term debt using their free cash on hand if they wanted to. For Ali's case, they have an FCF to long-term debt ratio of 6.73. This means they have 6.73 pesos of long-term debt for every 1 peso of FCF. Now, though we want this ratio to be at least less than 3, we still have to take note of the average for their industry. With this, Ali has a lower ratio compared to other real estate companies. The lowest is Megaworld, which has 4.47. So for this one, Ali's position is in a good ratio. By the way, most of the time, this ratio is used as FCF to long-term debt, at which they use percentage. So for that one, the higher the percent, the better. I just did it the other way around since I like to show it the same way the current ratio is shown. For me, it's easier to understand it this way. With this, going back to their debt to equity a while ago, though it is somewhat high, their revenue, net income, equity, and they have a good free cash flow on hand, for me, their high debt to equity compared to its competitors isn't that alarming, since with what we've seen, it's easy to say they can manage it quite well. Next, their PE ratio. For Ali, they have a price-to-earnings ratio of 46.97. This means we are buying their company for 46 times their earnings, which is quite overvalued, especially if we compare it to its competitors, which only have less than 10 PE. Now, this is quite normal for Ayala Land to be priced this much. Their 5-year low PE is only at 20, and their 5 years high PE is at 60. This means their PE ratio in the last 5 years has been dancing between 20 to 60. Well, this can be justified because a lot of Filipinos know the Ayala brand well. They believe in the capability of the company, which in time it has really shown to us that they are capable of growing. But for my checklist, the company is overvalued for the PE ratio. Next, does the company pay out dividends? So for every year, they pay out dividends. Though during the pandemic, it was the only time they decreased their dividend payout. As of now, their dividend yield is only at 0.78%. For the company's MOAT, what is the competitive advantage of the company? Well, financial-wise, revenue, net income, equity, FCF, ROE, they are all great. Their debt ratios, though a little bit high compared to its competitors, it's still well within the capabilities of the company, and we've seen they are putting those to good use by growing well the company. For their brand, Ayala is a very well-known company throughout the Philippines, and it's one of the best and largest property developers. Now for the company's leadership, their chairman is Fernando Zobel de Ayala, who had been in the position since 1999. He is also the president of Ayala Corporation and holds other publicly listed companies as well like AC Energy, Manila Water, BPI, Globe Telecom, and a lot more. And for their president and CEO, it's Bernard Vincent D. Had been in the position since April of 2014. Now with how well the company had been growing so far and how the Ayala's management team are creating successful companies, we can clearly say their leaders are well experienced. As for my buy below price, my computed intrinsic value is 53.85. With a 30% margin of safety, my buy below price is 37.65. As of the creation of this video, Ayala Land's price is 35.35. So it's still slightly below my buy price. With that, this ends my analysis of Ayala Land. We can see the company has strong financials and a managed debt. It was only due to the pandemic that their growth was cut hard. So if you like the company after watching this video, be sure to do further research about it. Don't just rely on this video. And if you want to know more about their competitors, I also have a stock analysis for them. There's a link down below. I suggest you watch it as well. So again, if you've learned something from this video, be sure before you leave to click the like button. And of course, if you still aren't subscribed yet, do click the subscribe button as well to be updated whenever I post a new video. So thank you and see you in the next video.